Hi everyone, Joe Kehrig with the Kehrig Real Estate Team, and this is your San Ramon Valley update for the week of June 27th. But also, this is going to be your monthly update of the overall real estate market and where we came from, where we are now, and where we think it's going. Like we talked about last week, a lot of changes in the last couple months. But let's go ahead and dive right in, because one of the things that has really been driving the market the last couple years has been interest rates. And obviously what's slowing the market down a little bit and adding more inventory is a rise in interest rates. So let's take a look, and you can see from the beginning of the year, literally you can see the interest rates going up and up and up and up. But see, here's what you see now over the last month and a half. We've actually seen a stabilization of rates. Now people will sit there and go, well Joe, didn't the Federal Reserve just raise it by 3/4 of a point? One thing to remember is what the Federal Reserve doesn't directly impact mortgage rates. It's the funds that they loan, the interest rate they loan to the bank. So it directly affects car loans, car interest rates and everything like that, but not mortgage rates, because what the lenders have done is they have baked in these increases. So even though we've seen an increase in the Federal Reserve, when you look at this graph, you'll see it's been going up and up and up. But literally the last month and a half, it's kind of settled and even gone down a little bit. We're going to talk a little bit about, when we get to the San Ramon Valley specific sales, what the market's kind of doing, and starting to see where we are now and if we expect any settling down. So anyway, let's look at the current mortgage rate compared to the last 5 decades. Everyone's sitting there going, oh my God, it's 5%, averaging at 5.9%. But look at it from the 70s, the 80s, the 90s, the 2000s, and the 2010s. The interest rates are still very attractive, but if you've only been in the real estate market the last few years, you would have think that it's gone up a ton. And you know what? It has made a difference, because it's gone from 2.5 to 5. So literally, mortgage rates have doubled in the last 6 or 8 months. But again, when you look at it historically, the interest rates are still very, very attractive. That's where we talk about, I would definitely be a buyer in this market, because the rates are still very good and we're actually seeing them settle down a little bit. So one thing always remember, you always hear a lot about the 10-year Treasury yield. Well, look at this graph and you will see that there's always a spread of 1.7. Now the spread right now is like 2.2, so rates are a little bit higher. But look at this, since 1972, man, the interest rate absolutely follows the 10-year Treasury. So when 10-year Treasury goes down, interest rates go down. When Treasury goes up, obviously the interest rates go up. And that's kind of what we're seeing right now. So when you pay attention to the 10-year Treasury yield, and it will also tell you what the interest rates are going to do. You look at this next graph, same type of thing. As I mentioned before, the average is 1.7, but the differential right now is like 2.2. So you definitely have a situation where the rates have jumped up a little bit. That's where the spread is as of June 2nd. Now, existing home sales. Look at nationwide the existing home sales, and you can see for 2001, it was 6.1 million, and they, based on the April numbers, they expected it to be 5.6. And you sit there and go, oh my God, it's gone way down. But I want you to look at the graph from 2020, 19, 18, and 17. You can see that 2021 was just an oddball year. So when they talk about sales are way down, yeah, compared to last year, but when you look at seasonal over the last basically 5 years, you can see it will probably come in number 2 next to 2021. And you see the existing home sales, the pre-pandemic sales, compared where they are right now, and they're still very, very good. Here's one of the big things I want to talk about. We know, I actually feel we're in a recession now. We're not in an official recession because we haven't had, 2 quarters of the GDP or whatever, but that's going to happen. We'll be in a recession. And it will actually be the 7th recession that I've sold real estate. I've been selling real estate close to 45 years, and I've sold through 7 recessions. And because of what happened in 2007, 2008, everyone's saying, oh my God, the real estate market's going to dump. Well, look at this. 4 out of the last 6 recessions, including the one from 2020 after the pandemic, real estate prices went up. And in 1991, they only went down less than 2%. It was just 2008 when they cratered, Because again, there was 2 million homes of inventory on the market. People were in these adjustable rate loans they couldn't afford. We are not going to see a repeat of 2008 and the foreclosures and the short sales, because people have built up so much equity. Even when the market peels back 10, even 20%, when homes have gone up 40, 50, 100% the last couple of years, people still have plenty of equity. And when you look at this graph, you'll see it. I mean, a recession doesn't mean prices going down. So it's something to look forward to, not from a standpoint of being in a recession, but not worrying about, the tanking of the real estate market. Because remember, we talked about 2008, there were 2 million inventory homes on the market. Right now, they say there's basically around 7 million short of what we need as far as housing on the market. Let me tell you why. The millennials are in the peak of their buying season, and over the last 14 years from 2008, the builders have been building 400,000 to 500,000 homes less than they normally would per year. So that's about 6 million homes that haven't been built that normally would have been built. So the supply and demand is still there. There's still a lot of demand. And obviously it's kind of good that we're seeing the supply build up a little bit. I'll give you a perfect example. Inventory, and you'll see when we get to the area graphs, have basically doubled. But yet there's about 350,000 homes on the market in the United States. And that's double of what there was not that long ago. But do you know in a normal market how many there would be on the market right now? 1.2 million. So we're still at about 25% inventory nationwide of what we would consider normal. Look at in the percentage of distressed properties. Again, people go, oh my God, is this going to happen in 2008? Look at basically this has absolutely flatlined in the last couple of years, because again, if you've owned your home for 2 years, you have hundreds of thousands of dollars of equity. So if it goes down 10%, this is kind of what we're expecting to see. In some areas like San Ramon, the market has probably peeled back 10 to 20%, Danville 5 to 10%, but yet just this year, the market's gone up 20 to 30%. So expect to see a little bit more of a correction, and maybe what will happen is we'll claw back all the appreciation from 2022, but we still have the 3 years before that when homes went up hundreds of thousands of dollars. So don't worry about foreclosures, short sales. It's not going to happen. There's still, the demand still is outpacing the supply right now with the market. And you can see the month's inventory of home. Yeah, it's gone up a little bit. But again, the reason I show you these graphs, because look at it compared to last year, May, June, July, and look at the inventory in April when the market started going up. It's still below what it was all last year. Not this year. Again, this year we hit January, and the reason prices have gone up 20, 30% is because there was absolutely no inventory out there, in the market. So now let's get right into our graphs. And I want to show you something that's really interesting. So let's look at San Ramon. Again, if you look at the last 6 weeks, you see the inventory going up and up and up, comparatively to 2-3 months ago when this was completely reversed the other way. But look what's happened the last 3 weeks, and you almost see this across the board. Look at the actual pending sales. So as many homes, pending sales dropped a little bit, but the last 3 weeks, even though the inventory's been going up, people are still buying homes. They're still taking advantage of, historically, these low interest rates, even though they're not the ridiculous 2.5%, the free money that we had before, but homes are still selling. Well, look at Danville. Same type of thing in Danville. Pending sales are down a little bit, but for the most part, they've been staying pretty consistent as inventory goes up. Danville isn't as out of whack as, let's say, San Ramon is. San Ramon has dropped a little bit more because it went up much faster than the Danville or Alamo market. Look at Blackhawk. As I was mentioning to my son, the last couple of weeks we've seen, for the first time that I can remember, there being more than 20 homes active on the market in Blackhawk. But again, pending sales have stayed pretty consistent. But I want you to think of this in the big picture. So in Blackhawk during 2008, there was about 200 homes on the market. And whenever Blackhawk over the years had dropped below 50 homes, we would sit there and go, oh my God, there's no inventory. And now we're sitting there going, oh my God, inventory has skyrocketed, yet there's 23 homes. And in a normal type market, if it ever dropped below 50, we would say there's no inventory. So that kind of goes along with the national news where everyone's saying, oh, inventory has doubled, but yet it's still only about 30% of what it would normally be during what we call a normal year, which the last couple of years definitely haven't been normal. Alamo, the same type of thing, inventory going up, but look at pending sales have gone up a little bit so homes are still selling. And the same thing when you look at the Dublin market. Again, inventory's going up, but look at the pending sales, staying pretty consistent. This next chart is going to kind of bring it all into play. If you remember a couple months ago, we were at 115 to 120 or more percent of selling price compared to asking price. So when we started dipping, I was telling you guys, hey, it's going to go low. It went down to 115, 110, and I will tell you right now, listen in 30 days from now, after 4 more weeks of this, and you're going to see almost all of these right about 100% or less than 100%. Now, when you look at this, obviously San Ramon, 104% of asking, Danville, 105%. Dublin dropped below 100%. First time we've seen that in a long, long time. 99% of asking. And in Blackhawk and Alamo, there were no closed sales last week. That's why we don't have any numbers there. But again, you're going to see all those drop down. But this doesn't show you the whole picture. Because if you have a home at $2 million, and what we're seeing at least 10, 12 price reductions a day through the San Ramon Valley. So if a home goes from 2 million to 1.8 and it sells for 1.8, it's going to show that it sold 100% of value, but it really didn't because it already dropped 10% and now it's selling at 100% of value. So when you see these numbers of things still selling at 100% of value, remember that probably 10 to 20% of those prices have dropped from where they were before. And that's kind of what you're going to see. We talked last week about being a buyer and a seller. So let me repeat it because we've gotten a lot of comments on that. If you're a seller, I would still be a seller in this market because what you have is there's only 3 things. I joke with my clients. I said after 45 years in the business, there's 3 things that can happen. The prices can go up, they can go down, or they can stay the same. And that usually gets a laugh, but that's kind of true. But there's not anybody out there that, any of the experts that are expecting prices to go up the next year as we get into this recession. Even though that chart I showed you, we don't expect them to drop because it doesn't mean a recession doesn't mean prices drop, but we expect them to stay pretty steady, but no one's expecting any huge increases as far as with the market. So if you take that off the board, there's only 2 things that can happen the next year. They can basically either stay the same or go down, maybe go down another 10%. So if you're a seller, and your plan, you just don't put your home on the market to sell, but if you have a plan to downsize or you're moving out of the area or whatever, I have a lot of clients right now that are basically sitting there going, hey, I'm out, my kids have 1 more year of school, I'm going to sell now and then rent for a year because they want to take advantage of the market. Even though it's not quite the peak, it's not that far off the peak, and if they know there are only 2 choices, is if they wait a year, it could stay the same, or maybe it goes down another 10%. Why not jump in there right now? And if you're a buyer, you saw what happened with the interest rate. The interest rates have kind of settled down a little bit, actually a little bit lower these last couple of weeks than they have been. And there is going to be some great opportunities in the market as we get through the summer. But the mess that we're kind of going through right now, in 30 days, it's going to be gone, 30, 45 days, because here's what we're seeing. We're seeing a lot of transactions fall through because if you have a $2.5 million home, and it's gone down 10 to 15%. That means it's gone down $300,000. So you have a $2.5 million home and you paid $2.8 million and you're in escrow and now that home is worth $2.5 million and you have a $75,000 deposit, no contingencies. Well, you don't have to be a mathematician. I'm not saying you should walk from the home, but I understand when people are walking from the home because they're saying, okay, the home's worth $300,000 less. I can literally walk away from my $75,000 and then basically go buy one for $300,000 less. Like I said, you don't have to be an Einstein to figure out just bottom dollar money-wise. But I will tell you, that is going to be over because what we're going through is this transition period where people bought at the high and then we have a 30, 45-day escrow. 30 days from now, what's happening now is if a home's worth $2 million, you're putting it on the market for $2 million and selling for $2 million. So if basically it drops another 5% or a couple percent, and you have a $60,000 deposit and it drops another $50,000, you're not going to be walking away. But what happens when the market starts to go down, you have this correction. And they say a correction is anything more than 10%. So I can basically tell you, at least in San Ramon, and in a lot of areas of Danville and Alamo and so forth, we've had a correction. Certainly in San Ramon across the board, 10 to 20%. Danville and Alamo, 5 to 10%. Now, you might not see it right away in prices, but here's where you see it. You list a home for $2 million, it was selling for $2.3, $2.4. Now you list a home for $2 million, it's selling for $2 million. So what happens when the market turns around and we have a correction, that last increase backs off. It doesn't stick. And that's what we're seeing right now. Now we're going to see, hey, is the market can continue to go down, or was that last, silly prices that people were bidding homes up to. So as always, it's a very complicated market. You need a real estate professional to guide you through it, someone that has experience. If you're looking for someone, give me a call. Again, 45 years in the business, having sold through, it's going to be coming up my 7th recession. And I can guide you through every neighborhood. When I talk about San Ramon or Danville, understand I'm talking about general. Every neighborhood's a little bit different. There's some areas in like Danville and San Ramon that haven't gone down a nickel because they're very desirable areas. So, but if you want to try to work out a plan and talk about a plan and figure out what your home's worth and what the future looks like, give me a call, Joe Kehrig, the Kehrig Real Estate Team. My cell number, 925-487-6838. Drop me an email, joe@kehrigteam.com, or visit our website if you want to look at our inventory and kind of meet the team, www.kehrigteam.com. Again, in this market, you need someone who has seen this market and navigated this market. And in my case, I've navigated something like this 6 different times in my 45-year career. So make sure you stay tuned, weekly updates, and then every month I'll update overall what the market's going. Thanks again. We'll see you next week.